All right, so options trading, huh? Ready to go deeper than just the buy and sell.
Deeper, yeah. It's like a whole other level of strategy.
We're talking calculated risks, but potentially some pretty sweet wins too, right?
Definitely. And to guide us, we've got articles from, let's see, Wealthsimple and Questrade.
Good mix there. Wealthsimple's got this fictional stock, Kale, to illustrate the ideas.
And Questrade, they get into the nitty-gritty. Charts, definitions, the works.
Okay, so before we get lost in the weeds, what exactly is an option? Not the same as owning a stock, is it?
Right, it's different. It's like a contract. It gives you the right,
Okay,
not the obligation, to buy or sell a specific stock
gotcha.
at a set price. We call that the strike
Base
price.
strike price, okay.
And this contract, it has an expiration date too.
So there's a time limit on this whole thing.
Exactly.
This, right, but not the obligation thing.
Yeah.
That's kind of interesting. So let's say I buy an option and things change. What are my choices? I'm guessing I don't have to go through with it if I don't want to.
You got it. You've got flexibility. You could hold on to the option, see what happens.
Okay.
Exercise it if it's looking profitable, or even, this is interesting, you could sell the option itself to another trader.
Before it expires.
Yep, before it expires.
Ah, okay, so that's where it gets more dynamic than just regular stock holding. But hold on. What are we actually speculating on with these options contracts? What's the bet?
That's where the terms calls and puts come in. Those are the two types of options you'll see.
So it's like picking which direction you think the stock's going to move.
Precisely. With a call option, you're betting the stock price is going up. You're buying the right to buy that stock at that preset strike price, hoping the actual market price goes way above it.
So you can buy low and sell high.
Exactly, and pocket the difference. Now, on the flip side, there's a put option. That's where you're betting the stock price is going to drop.
Ah, okay, so you're buying the right to sell at the struck price,
You got it.
hoping the market crashes below that.
Exactly. Making money if the market tanks below your strike price.
So if I think a company is about to release some game-changing product, I'd buy a call option.
Yeah, if you think their stock's about to skyrocket, you'd buy that call option, hoping to buy the stock at your lower strike price.
Right.
And then turn around, sell it at that higher market price. Boom, profit.
This Kale example from Wealthsimple is starting to click now. They imagine Kale's trading at $150 a share. You buy a call option with a strike price of $170. What stood out to me is they showed how a $500 investment in options could make you $500 profit, compared to like only a $100 profit if you just spent that $500 on Kale shares directly. Why is such a big difference?
Leverage, that's the key. Options, they let you control a bigger chunk of stock, but with a smaller upfront investment.
Okay, makes sense.
So you've got greater potential for gains, but also keep in mind greater potential for losses too. It magnifies both sides.
Options are like a high-stakes game, big rewards, big risks. But what if Kale doesn't actually hit that $170 mark?
That's the risk, right? If the stock price stays below that strike price,
Yeah.
by the time your option expires, it's worthless. You lose what you put in.
All right, starting to see the downside here. But Wealthsimple also mentioned you could sell the option before it expires.
Right.
So even if the stock is like moving in the right direction but hasn't hit that magic number yet,
You could still cash out.
you could still cash out.
Exactly. You don't have to wait until the very end. If the price is moving favorably, sell the option before it expires, and boom, you've got a profit.
Okay, so there's more flexibility here than I initially realized. Now, on the flip side, let's say I think Kale is going to tank. Bad earnings report, stock price plummets. That's where those put options come in.
You got it. You'd buy a put option with a strike price above the current market price.
Hmm.
If the stock goes down, you exercise your option, sell at that higher strike price.
Okay, starting to see the strategy here. Now, this hedging concept, Wealthsimple talked about that too.
Yeah.
They gave the example of owning a bunch of Kale stock, but you're worried about like a sudden drop. They said buying a put option is kind of like insurance. Is it really that straightforward?
Well, it's never that simple in the market, right?
Right.
But in essence, yeah, it allows you to lock in a selling price. So even if the market takes a nosedive, your losses are limited.
It's like a safety net, even if you're generally optimistic about a stock. Besides that hedging and the potential for bigger profits, why else would someone choose options over just buying and selling stock directly?
It comes down to strategy. Options, they allow for more, shall we say, nuanced plays.
Yeah.
You can fine-tune your bets based on not just whether a stock will go up or down,
Right.
but by how much you think it'll move and by when. It's not just up or down. You're factoring in timing and the magnitude of the move.
Okay, so it's more about being in control, not just riding the wave. Sounds pretty powerful.
Yeah.
but also pretty complex.
It is.
Before we get into any specific strategies, though, let's talk about how to read an options quote. It's not as simple as just looking at the stock price, right?
No, you're absolutely right. There's more to decode. Thankfully, Questrade, they give us a good breakdown of the key elements.
Yeah.
Things like the underlying asset, the expiration date, that strike price, and whether it's a call or a put option. All that's packed in there.
All right, let's try deciphering one of these codes. I'm looking at a quote that says XYZ tune of 21124C. Honestly, it looks like gibberish to me.
It might seem that way at first, but it's actually quite logical.
Okay.
XYZ, that's the stock ticker symbol, represents the company the option's tied to. TIN of 21, that's the expiration date, November 10th, 2021 in this case. $120, that's our strike price. And the C at the end, that tells us it's a call option.
So this whole thing basically means someone has the right to buy XYZ stock at $120 per share, but only until November 10th, 2021. Got it.
Exactly. And there's even more information packed in there. You'll see things like the bid and ask prices, the volume, and something called implied volatility, which we'll get to later.
Okay, we've covered a lot of ground already. We've gone from, like, the basic idea of an option to deciphering those secret codes. It's clear these are more than just a simple bet. There's strategy, nuance, it's a whole other ball game.
That's one way to put it. Options offer a lot of flexibility, but, and it's a big but, they do require a deeper understanding of how the markets work.
Before we get too deep into that, let's do a quick recap of what we've learned so far. We've got the basics of options, the two main types, how to understand a basic quote. Now let's explore what actually makes an options price tick.
So we've decoded the basics of options, but to really get this, we got to understand what drives their price.
Yeah, it's more than just looking at the stock price, right?
Way more. We've touched on things like time value and implied volatility.
Right.
But what really makes up an options price?
Yeah, break it down for us.
Think of it like a recipe. Two main ingredients. You've got intrinsic value
Okay.
and time value.
Intrinsic time, got it.
Intrinsic value is, well, it's simpler. It's the inherent worth. Like, how much is this option worth right now? Based on the difference between the stock's actual price
Okay.
and that strike price.
So it's basically how much money I'd make if I exercise the option right this second.
Exactly. Let's say you've got a call option for kale. Strike price of $170.
Yeah.
Kale's currently trading at $180.
Okay, I'm following.
The intrinsic value there would be $10 per share.
Because I could buy it at 170, sell it at 180, boom, $10 profit.
You got it. Now, time value, this is where it gets interesting.
Hold on, if intrinsic value is what it's worth now, why would there be extra value on top of that?
Time. Time is the answer. The more time left before the option expires,
Yeah,
the greater the chance that stock price could move even more in your favor.
makes sense. So even if an option is out of the money, we talked about that,
Right.
meaning it wouldn't make me money to exercise it right now.
Yeah.
It could still have value because, hey, there's time for the stock to change.
Precisely. Time value, it's like a premium, yeah, based on the uncertainty of the future. Like a ticking clock, adding value to the option.
A ticking clock, I like that. But as we get closer to the expiration date,
That time value melts away.
it disappears.
Go-
So how do those two values, intrinsic and time, actually work together to determine the option's price?
Pretty straightforward, actually. The option's total price, we call that the premium.
Okay.
It's basically intrinsic value plus time value.
So if we stick with our kale example, intrinsic value is $10, right? Stock's trading at $180. But let's say there's also $5 of time value because the option still has a ways to go before expiring. Total option price would be $15.
Exactly. And that $5 time value is going to keep shrinking as we get closer to that expiration date. In fact, at expiry, time value is always zero.
So timing really is everything in options trading. You've got to be right about the direction the stock's moving, but also about when it's going to make that move.
You got it. And all of this ties into those terms, remember, in the money, out of the money.
Of course, we talked about how in the money, ITM, means it would be profitable to exercise right now.
Yeah.
And out of the money, OTM, means it wouldn't. But you said even those OTM options can still have value.
They can. See, you've got that kale call option. Strike price is $170. But kale, it's only trading at $160 right now.
So it's OTM because I wouldn't profit from exercising it at this moment.
Right. But, and this is key, if there's lots of time left before that option expires, there's a chance kale could climb above $170.
So the time value is basically saying, hey, it's a long shot, but it could still happen.
Exactly. It might not be worth anything now, but it has the potential to be worth something.
Okay. Starting to see the appeal here. But got to talk about risks, too. Options seem, well, kind of complex. Lots of ways to lose money, it seems like.
Right. Got to be aware of the downsides. Big one is options. They have a lifespan.
Unlike stocks, where you can just hold on forever, theoretically.
Exactly. Options, they've got that expiration date. Stock price doesn't move your way before then. Could lose everything you invested.
So it's not like owning a piece of the company. It's a bet with a deadline.
In a way, yeah. And don't forget about volatility. Market swings, you know. Even if you're right about which way a stock's going to move, a sudden market shift could wipe out your gains.
So you're not just betting on the stock, you're betting on how stable the whole market's going to be.
You got it. Options are sensitive to both stock's price and overall market volatility. Things get uncertain. Option prices can go haywire, even if the stock itself isn't doing much.
And this time value thing adds another layer of pressure, right? It's like a countdown timer.
Absolutely. Got to write about the direction and the timing. Options trading, it's not for the faint of heart.
Chris Strayed mentioned liquidity as a risk, too. What's that all about?
Liquidity, it's how easy it is to actually buy or sell an option. Highly liquid options, they got tons of buyers and sellers.
Easy to get in and out.
Exactly. But some options, especially those that are way out of the money or close to expiring, they can be illiquid. Hard to find a buyer when you want out.
So you could be stuck with an option that's losing value and no way to get rid of it.
It's a possibility.
Yeah.
It's like trying to sell something nobody wants. Tough to find a buyer at a price you're happy with.
All right, so options can be powerful, but they're complex and risky. So given all that, who are they really for? What kind of investor?
That's the million-dollar question. And the answer is, it depends. Options are not for everyone. They're best for investors who really get the markets, are comfy with risk, and are willing to put in the time to research, build a solid strategy.
It's not just about gambling on big wins. It's about knowledge, experience, knowing you could lose money.
Exactly. For the right investor, though, options can be a fantastic way to boost returns or hedge against a downturn. But got to be smart about it.
So we've got the mechanics, how prices work, even the risks. But I keep coming back to this question. Who are options really for? It's like there's the safe and steady stock world, and then this whole fast-paced options thing. Are they even playing the same game?
It's not about which one's better. It's more like which matches your goals, your style as an investor.
Okay, thought experiment time. Let's say we're advising different investors. Who should be checking out options and who should stick to the basics?
All right, I like this. So picture someone brand new to investing, just starting out, building a long-term portfolio, retirement maybe, options right away. What do you think?
I'd probably say pump the brakes. Options, they're tempting, right? Big wins. But big losses, too. Learn the ropes first, I'd say. Get comfortable with stocks, ETFs, how the markets work, then maybe think about options.
It's like you don't start driving by hopping into a race car. Got to get the basics down first.
Now let's say we've got someone with more experience. They're actively managing their portfolio, maybe making trades regularly. They're okay with a little risk.
Now we're talking. Someone like that, options could be a great tool for them.
Yeah.
Boost those returns, hedge their positions, even generate income.
How do they do that?
Strategies like covered calls, didn't get into those today,
Right.
but definitely worth exploring.
Options are like, I don't know, a power tool. In the right hands, amazing.
Exactly. But got to know what you're doing.
Even for experienced investors, though, options trading, you got to stay on top of it, manage that risk carefully.
Couldn't agree more.
It's not about throwing darts and hoping for a bullseye.
Nope. Strategy, understanding the risks, knowing you could lose, that's key.
We've given our listener a lot to digest today. Demystified those options, the potential, the risks. What a world.
It's a lot, right? But remember, this was just the intro.
The tip of the iceberg.
Options trading, there's so many layer strategies, all these techniques we could talk for hours.
It's a rabbit hole for sure.
Yeah.
But that's what keeps it interesting.
It is.
Always something new to learn.
Investing, always a new challenge, new opportunity to test yourself. That's the fun of it.
All right, so to our listener, we'll leave you with this. Where do you see yourself fitting in with options trading? Intrigued? Ready to dive deeper? Or are you playing it cautious, sticking with the fundamentals?
Yeah, good question.
Whatever you choose, keep learning, stay informed, and always, always invest responsibly. Oh,